Ladies and gentlemen, a few days ago, I published a video stating that a bull run is about to start for one of the assets. Indeed, it has started and the bull run is pretty strong. So let's just watch on and I'll give you the science behind it. And more importantly, what are the upside and the risk? Let's watch on, shall we? If you were to recall, a few days ago, I mentioned in a video that the bonds bull run is about to start. And guess what? It has started and it ran on pretty strong. The TLT, for example, as one of the bonds fund has went up 1% yesterday night and the day before as well. And this signs of more potential upside. And as the interest rate cut is going to come to pass, this certainly pushes the bonds with a strong gaining momentum. Let's watch on to understand the science behind this. And more importantly, where are the potential upside and maybe even some downsides. As usual, this content is for education, entertainment, not telling you to buy bonds. Okay, this is just to share with you what I have done and what my portfolio is heading. And this is not financial advice. Remember, hit subscribe. You don't want to miss some of this exciting content. So first, we got to understand why is the bonds having a bull run. And I share with everybody again and again. But I think a lot of people still don't understand. And today I'll attempt to go a little bit deeper to give you the understanding why bonds going in a upward direction. So first of all, bonds and interest rates have an inverse relationship, meaning that when interest rate goes down, bond prices goes up and the reverse as well. So falling interest rate directly drive up bonds prices through a mathematical near certainty. Okay, that means when interest rate come down, almost certain, okay, not 100%, like 90% chance there's going to be an uplift in bond prices. And I will show you, with the example of using TLT, a counter, it's a bond fund, the 20-year Treasury ETF or an equivalent, which they actually has very high sensitivity towards a Federal Reserve rate decision. And essentially, what I've been taking on is a bet that eventually the Federal Reserve will cut the interest rate and the day is probably here. Let's take a look at the bond fund in a simple way. I have attempted to understand, to help everybody understand in a different way, but today I'll just show a more simple way. Now, a bond is basically a piece of paper from a government entity or from a company that basically say I owe you, right? It's a piece of paper that I owe you. So in the case of the US government, for example, or the Singapore government, they issue a bond called a T-bill, right? And it promises you, in 6 months' time, in 1 year's time, for example, in 10 years' time, 30 years' time, I will be giving you every year or every month or every quarter a certain payment. So it guarantees a stream of payment, and usually government guarantees are very strong. So a bond, how does the bond value is priced is basically the stream of money that's coming, every quarter they will pay a certain sum of money, okay? And they sum that up to 30 years, for example, it's a 30-year fund. Then how much is the bond value? Is very simple. Sum up all the string of payment that's going to come over 30 years. Now, unfortunately, there's such a thing called present value, which basically means that in today's terms, future dollar worth less, right? So today, let's say this year I get $10. Next year, $10 is worth less, okay? So what the economists and financial analysts does is a process called discounting, right? So they actually say your future cash flow got to discount by an opportunity cost called interest rate. That means if I put the money elsewhere, like in the bonds, for example, you put in a bank or something like that, at least I get interest rate. So they at least, discount the stream of income by the interest rate. So therefore, bonds are very sensitive to interest rate movement. So when the interest rate goes up, the value of the stream of money that's coming in is value less in today's terms. So when interest rate falls, opportunity cost lowers, the stream of money that coming from the bonds is value higher. So that explains the reason why when the interest rate goes up, the stream of income that is valued today comes down, okay? And therefore the bond price goes down, okay? And right now we are facing the reverse. Interest rate is likely to come down and therefore the bond prices is like go up because the stream of income that's coming in from the bonds is value now higher. Okay, so clearly the longer the duration is, the higher the value fluctuation is respect to the interest rate movement. So interest rate adjustments affect longer duration bonds more. So as a result, 20 plus years treasury bonds like TLT, yesterday has gone up by 1.18%. If you evaluate over the last few days, it's gone up even more. Okay, so the TLT is not the only bond funds, right? I've also invested in the PIMCO fund, and that time I invested in the PIMCO fund was somewhere around here. And look at it, it's also gone up, right? Now, bond prices do not go up rapidly like the NASDAQ, S&P 500, NVIDIA, or whatsoever. It goes up gently but surely. More certainty but slower. And that's fine, right? Because we have a balanced portfolio of some bonds and some equities. And there are many bonds funds altogether. I'm just using these two as illustration, not telling you to buy these two funds. The TLT effective duration is about, they measure about 15.6 years. This come out of ChatGPT. And right now, I've asked AI to help me do a simple analysis. If there's a 1% drop in interest rate, how much will the price goes up by? And they calculated about 15.6%. So take this number a pinch also. It could be 10, it could be 20. I don't know with precision, but going up is a near certainty. So if the TLT trades about $88, $89 today, which is yesterday's closing price, a 1% cut in the Federal Reserve rate cut would drive the prices towards $100 range, right? And it's very comfortable, right? So if you have $100,000, you will make, $10,000, right? So just to show you that this has happened before, when in 2020, when the Federal Reserve started to cut the interest rate, the bond price started to fall as well, right? So this is the TLT price. It fell and fell and fell and fell. Actually, somewhere around here, it actually was doing well. It started to go up. Then Donald Trump came in with his crazy tariffs, and that set everybody go up because there are fear of inflation. But seems like the inflation didn't really materialize. So the bond prices are likely to go up because the Federal Reserve is now looking at job numbers. The job numbers are not looking good. They have to cut interest rate, right? So clearly, right, the inverse relationship between bond prices and interest rate is a well-established market evidently and empirically. So let's take a look at the current market situation today, right? The 10-year Treasury yield today stands at 4.1%. It's down a little bit adjusted by the Federal Reserve from last few years, but it's still relatively high. And right now, the market is really anticipating that Federal Reserve will cut the interest rate at least one time this year, most likely two times. And there are some people say that maybe they'll even cut three times. Okay, if that were to happen, both the bonds market and stock market will go to the roof. Okay, and I think positioning myself in long-term treasury over the last 1 year, I've been positioning myself. Now we're beginning to see some fruits of return. Now, of course, a lot of people say, Mr. Lu, why don't you tell me now? No, I told you 1 year ago. I told you 6 months ago. I think a lot of people like to just buy something before it go up and don't like to buy something way before it go up, and they have no patience to wait. I can understand, and that's just to share with everybody that investment require a long patience and long patient wait. So I already said this, if there's a 1% rate cut, which the market could anticipate there to be one, then price appreciation of bonds will go up. And in the case of long-term funds like TLT, it could go up by 15 to 17%. But let me say this, so there are risks as well, and I will share with everybody what these risks are. What are these risks is, of course, is difficult to estimate. Number one, we have a very volatile and difficult to predict precedent in the United States. So you can do something stupid to crash this. So one of it is the rising debt level. I personally think the debt level right now will come to under control. I didn't say it will go down, come under control. Doesn't come through, then the confidence of the investment community towards US Treasury will go down, and suddenly that would then cause the bond prices to crash. Now, if the creditworthiness were to lower again, the credit rating agency like Standards and Poor, Fitch, and so on, if they lower their credit rating because they say, wow, US now very dangerous, right? Bond prices will come down as well. Now, we have all anticipated that inflation will be moderate, okay? Moderate, won't go up or won't go up much or maybe even come down. But supposing we are all wrong, inflation suddenly spiked up, and we will know tomorrow or the day after tomorrow there is a release of the inflation news. If that were to happen, that the inflation suddenly spiked up, then you will cause the bond price to start to come down again, right? So things are very fluid and very dangerous, hard to predict. But all things constant right now, looking at where the trajectory is, there's a strong, not 100% likelihood of a Federal Reserve rate cut. Okay. And certainly one last thing is that if all the countries of the world start to boycott US Treasury, and US Treasury have a result have to increase the yield of the bond prices, then that could set the bond prices come down. So it's not without risk, right? It's not without risk. My key investment takeaway is this, okay? Right now, I'm taking a bet, and my bet is a strong one from the point that there will be an interest rate cut, and there will be interest rate cuts coming, not necessarily just this year, but next year. This is a strong bet, but it's up to you to believe what you want to believe. I myself cannot be 100% sure, but it's just taking a bet. In some sense, when you take a bet, it is a calculated gamble, okay? And I hope that all the macroeconomic environment remains stable from now on. I have the validation from history that tells me that there is a inverse relationship between bond price and interest rate. And of course, I always diversify my positions. I don't throw all into TLT. I don't throw all into PIMCO. I just diversify out in the various funds. I diversify out in the other assets as well. That's how I do my bets. Now, a lot of people say, Mr. Lu, why do you need bonds, right? Now, in textbook case, bonds and equities are a must-have from an investor portfolio perspective. You like to have some bonds and some equities to spread out. Now, the textbook case is 70-30 when you're young towards equity, and when you go old towards the 70% bonds, 30 equity, is basically try to provide some stability to a portfolio where we bonds, and they move in different direction, right? They cushion the volatility from each other. And the bonds itself pays a decent return in terms of bonds coupon payment. So it's like a dividend as well, right? But this one is backed by government, not like dividend stocks. So in that sense, bonds are a very textbook case of what people should have now. Whether you should have is unique to a situation, but this is a textbook case. Right now, to sum up, the investment decision framework that I put up is this. Right now, there's likely to be a rally, and there's a lot of evidence that point to it, but there could be risk as well. The strong factors that lead to it is there could be a strong price to duration sensitivity, meaning that when the interest rate goes down, long-term bonds will go up. And second is that we are betting that the Federal Reserve could ease the interest rate moving forward, and therefore this set the bond price to go up. However, there could be some risk as well because of the fiscal deficit situation in US, and potentially some policy risks as well in terms of tariff and inflation. And maybe, because of geopolitical reasons, a lot of countries start not to buy bonds from US and things like that. So I'm putting myself in a very decent small position in bonds that takes this bet, okay? But yet I diversify my portfolio to take some risk away, right? What you should do, you decide for yourself. I'm not telling you what to do. I'm just sharing with you what I do, okay? So just go do some research, a lot of research, and then make the decision yourself, okay? Yeah, so I'll see you tonight, possibly for live stream. Bye-bye.